So you're familiar with the term hard money and how many people use hard money to fund their fix and flip deals. Well, does the term hard money make that financing seem unavailable to you? Well, in today's video, I'm going to walk you through the hard money terms and why I find hard money to be easy money. Stay tuned. Okay, so I'm back at the whiteboard, and I took my time to write down the differences between traditional funding and hard money funding. And again, when I use the term traditional, that is going to be what traditional banks offer. There may be some smaller banks or smaller credit unions that offer different ways to fund deals, but this is just traditionally speaking in comparison to hard money. And on this hard money, we're using this in reference to flipping a property, because you can actually use hard money to get into buy and holds as well. And this is hard money referring to flipping a property. So I'm going to go right down into it. Okay. Traditional banks are going to want to see 20 to 30% down payments on your investment properties, versus hard money can range from anywhere from 0%, depending on the relationship you have with that hard money lender, to 20%. So right off the bat, you can see that the ease of entry would be with hard money, when you can range from 0% to 20% to get into a property, versus coming down with 20% right off the rip. Now, most hard money lenders and traditional banks charge points on their deals. And again, what points means, just to break it down for you really quickly, is 1% of every $100,000. So, for example, 1% of 100,000 is $1,000. So if it was 2% of 100,000, it would be $2,000. If it was 3% of $100,000, it would be $3,000, and so on and so forth. So a point is 1% of the deal. Okay. Now, traditional banks offer long-term financing, and that can be anywhere from 5 years to 30 years. Okay. Hard money lenders, they usually offer short terms, which is going to be 12 months to 6 months. And the reason why I put the terms first is because, just so you notice, that the hard money terms are a lot shorter, but their interest rates, if you can see here, 8% interest rate to 18% interest rates are what most hard money lenders are going to be looking for when they lend their money, versus a traditional bank, you might get interest rates going from as little as 3% to 8%. And traditional banks are going to require monthly payments as well, and so is your hard money lender in most cases. You know, some hard money lenders may actually give you one lump sum at the end of the term, and some have monthly payments. And usually for hard money lenders, the monthly payments are going to be interest only, versus traditional banks, you might have the monthly payment, will have the interest plus principal. So you're actually paying down the loan, versus in hard money, you will not be paying down your loan, you'll be making interest only payments. Okay, and again, another difference between the traditional funding and hard money funding is repair costs. You may put down 20% and not have any money to actually make the repairs, versus in hard money, they'll actually offer you a low down payment or no down payment, and they will provide 100% of the rehab cost. So again, hard money, low down payment, 100% of the rehab cost. Short terms, high interest rates. This is in comparison. Traditional funding, higher down payment, longer terms, lower rates, but they may not offer the rehab cost. And now, this is the part that actually makes traditional funding hard versus using hard money. Before banks go ahead and give you a loan, traditionally going to want to see your W-2s, your tax returns, seasoned funds. Okay, so W-2s may be for the last 2 years, tax returns maybe for the last 2 years. Seasoned funds, which means they want to see where the money came from if it hasn't been sitting in your account for more than 2 months. Okay, they want to see where it came from. They want to see that it's been seasoned funds. Okay, they might be a lot more stringent on the credit scores or credit ratings. They want to have a stronger credit profile. They may need 60 days to close. Okay, and most times before a traditional bank lends on an investment property, they're going to want to make sure that property is habitable at the very least. Okay, versus hard money. Okay, well, they will actually pay 100% of the rehab cost, and a lot of time they won't base your decision whether you get approved or not off your W-2, tax returns, seasoned funds, credit scores, and whatnot. if you can prove that you can buy the deal, fix the deal, sell the deal at 70% of the ARV, and again, this is 70% of the after repair value, most hard money lenders will close in 7 days. Why? Because the deal is their leverage. Now, of course, they're going to do the due diligence. They're going to make sure that ARV is correct. But at the end of the day, if the ARV is correct and the budget, an estimated budget is correct, and you can buy, fix, and sell this deal at 70% without even needing all this, your hard money lender may close in 7 days because the deal is the leverage. And keep in mind, when they get this deal, they also get the down payment, whatever it may have been, and they get the points up front. So again, if you fall through and don't actually end up being able to close on this deal or flip this deal, they can either keep the 30% equity for themselves or sell the deal to somebody else and collect a new down payment and more points. So listen, don't be scared to approach a hard money lender. They want to work with you. They want you to go out and find the deal and do all the elbow grease, put the deal together. And they want you to be successful as well. But in the event that you're not, they keep the deal, they keep the 30% equity, they keep the down payment, and they keep the points. So really, the risk is really on you. So in comparison to a traditional bank, hard money, the terms are harder. And that's why it's called hard money. Because of the points, because of the interest rates, because of the short terms, okay, makes hard money, quote unquote, hard. But keep in mind, not all hard money lenders are created equal, and these terms may be subject to change based on the hard money lender themselves, or the deal, or just the timing in the market. Some hard money lenders may require W-2s, tax returns, seasoned funds, high credit scores. And some hard money lenders may only require that you have a separate entity or some sort of an LLC to lend to. Some hard money lenders will actually hold real estate meetings monthly and offer training and mentorship to first-time flippers and first-timers. So again, not all hard money lenders are created equal. That's why it's your job to get out those networking events, shake hands, rub elbows, meet hard money lenders, grab term sheets. But because there's so much flexibility, I consider hard money easy money, okay? Because depending on the relationship with the hard money lender, ease of entry to the deal. It could be zero, but traditionally hard money lenders require 10% down. So 10% down versus 20% down. So we have ease of entry to the deal. And a lot of times, you know, I don't have 60 days to close on the deal. 60 days, you can miss a market. If I'm going to sell a home and I want to sell it in a buyer's market, 60 days, that market can sail by. I want to be able to close my deal in 7 days fast. If I find a deal, I want fast closing. Another reason why I would use hard money, right? And to me, it's easy money. Also, traditionally, banks are going to want to see, again, W-2s, tax returns, seasoned funds, higher credit scores, and the property must be habitable. A lot of times it must be habitable. But over here with the hard money, if I can buy it, fix it, and sell it at 70% of the ARV, the deal is the leverage. To me, that is easy money. Collect the 10%, put together the team that has the know-how, approach a hard money lender. And I hope this brings you that much closer to reaching out to a few hard money lenders yourself, getting some term sheets, and start putting together a plan to reach your financial freedom goal. What I want for me, I want for you. Let's grow together. Don't forget to like, share, comment, and subscribe. I'll see you on the next video.